Hi, I'm Ian Stewart, Chair of the Board of Leithner Company. This February 2024 presentation is another in the series of video updates on the performance of Leithner Company and includes information which we believe may be of interest to both our current and potential future shareholders. We hope our presentation will encourage potential shareholders to undertake their own research of the operations and goals of our company. Our website is a great place to start. You may be surprised to find we charge no base management fees. Rather, we practice a co-investor model where management only makes money when our shareholders make money. Our methods are based on the value investing philosophy of financial legends Warren Buffett and Benjamin Graham. Accordingly, we are conservative, long-term investors who aim to create wealth while striving to protect your capital. And did I mention that Leithner Company, in its 25+ years of operation, has never failed to pay a regular 6-monthly dividend? I trust you will enjoy this presentation by co-managing directors Dr. Chris Leithner and Mr. David Guy, facilitated by my fellow non-executive director, Mr. Chris Satrafillis. Thanks, and over to you, Chris.
Thanks, Ian, and welcome everyone to this update. Before proceeding, please pause the video to have a good read of the disclaimer. In this quarterly update, we're going to cover 4 sets of points. Chris will review the company's long-term, medium-term, and short-term results. Then David will review company's recent sources of income and how these dividends are distributed through various sources to our shareholders. David will also profile the most recent major addition to the company's portfolio. And finally, I'll review how prospective investors can become shareholders in Leithner & Co. Let's turn to the slide now, performance since inception. And since 1999, and definitely since the global financial crisis, we've outpaced the All Ordinaries Accumulation Index. At least 80% of managers failed to do so. Chris, please tell us more.
Thank you, Chris. Each $1 invested in Leithner Company in December of 1999 grew to $6.55 in December of 2023. That's a compound annual growth rate, CAGR, from December 99 to December 23 of 8.2%. The All Ordinaries Accumulation Index's CAGR is 8.0%. Whether during the GFC or during the COVID-19 crisis in February to May of 2020, we've outperformed when the All Ords has swooned. The extent and the length of our outperformance during and after the GFC is particularly worth noting. The lesson is crucial. We like bear markets because, by allowing us to put cash resources to use, they set the stage for long-term outperformance. The slide also shows that our compounding of investors' capital has been much more stable. That is, it's experienced fewer downdrafts than the index. Over the past quarter century, we've not just outperformed, we've done so with less volatility than the index. Okay, let's now shift to our results since January of 2020. Each $1 invested in Leithner & Co. in January 2020 has grown to $1.32 on the 31st of January of this year. That's a CAGR of 7.2% versus the index's 6.6%. It's important to emphasize, during the COVID-19 crisis of 2020, we lost relatively little and thus greatly outperformed when the All Ords plunged. The slide also continues to show that our compounding of investors' capital has been much more stable, subject to fewer fluctuations than the index. In the medium term too, we've outperformed with less volatility than the index.
And what about the last 12 months, Chris?
Right. We don't always outperform, and the 12 months to the 31st of January of this year is an example. Each $1 invested in Leithner & Co. has grown 6.8%, whereas each dollar invested in the index has risen 7.2%. Importantly, though, our return continues to be less volatile than the indexes. Our 12-month return standard deviation is 2.2% versus the index's 3.6%. The most important thing is that these steady but not earth-shaking short-term results, and most importantly, minimizing losses, these are the things that explain our very long-term outperformance.
And we haven't just outperformed. We haven't just generated comparatively stable results. We've done so with much less risk than the index.
The graph plots our portfolio's allocation to non-equities, that's interest-bearing securities like bills, deposits, and so on, at half-yearly intervals since 1999. We've always followed Benjamin Graham's 75-25 rule. That is, stocks should comprise at least 25%, but no more than 75% of a conservative investor's portfolio. Since 1999, our split has been approximately 50-50, and it's currently approximately 63% stocks and 37% deposits and the like. The key message is that we've outperformed not despite our conservative asset allocation, but because of it.
Okay, let's now turn to the next slide around the sources of income in 2023. Leithner & Co. generates income from 4 sources, David. Please take us through them.
Great, thanks, Chris. Yeah, we derive income from 4 sources. 2 are reasonably consistent and recurring. That's dividend and interest. The other 2 are a bit more variable. So we receive income from options premiums, selling options to either acquire or dispose of shares, and realized capital gains. Both of those are a lot more variable. If you have a look at the slide that's there, you'll notice that dividends have become an increasing part of our income. So if you compare the July to December half year to the January to June half year in 23, you'll notice that the purple portion of the bar is considerably higher. So dividends have gone from 30% of our income to, say, 60% of our income over that period. So that's significant. And from our perspective, it's significant because it's recurring income. It's stable income. It'll in all likelihood repeat going forward. You'll also see there the interest portion has increased pretty significantly as well. So in both of those cases, our half year to December, the dividend and interest were considerably higher than the previous 5 years, which makes sense. Interest rates, as we all know, were historically low for the previous few years, so that's coming through. But importantly, from our perspective, the companies that we own are also paying increasing dividends. Might just go to the next slide. So this looks at the overall dividend in a total number. So the average 5-year dividend on the far right side, you'll notice, includes realized capital gains, ETO premiums, a reasonable portion of dividends, and a smallish portion of interest. If we then look at the last 3 6-monthly periods, so February 23, August 23, and February 24, the key thing to notice there is the increase in dividends and interest over those periods. They're increasing pretty significantly. And even though we didn't realize much capital gains or sell many options in the February 24 number there, the dividend is still almost as large as it was when we were realizing considerably larger amounts of those variable sources. So the good thing from our end is dividends are increasing, interests are increasing, and they're not certain, but they're very consistent forms of income. Just go to the next slide. More importantly, even, we've just had most of the results for our underlying companies being reported, and we've seen significant increases in dividends. So Horizon, we're looking at a 20% increase, IAG 20%, Origin close to a 40% increase in dividends. Santos, a doubling of their dividends, and that wasn't reported in those previous numbers I've shown you. So we're looking forward on our dividends. It's going to be increasing as well. One other one there is Unibale, which is the old Westfield, has actually started reinstating its dividends or distributions. So there is a significant amount of underlying dividend income coming through. And again, we're still earning reasonable interest income as well. So the future looks quite bright in terms of those underlying consistent forms, so the dividends and the interest. And we also have some situations where we're probably getting close to realizing some capital gains. It's a bit hard to always tell exactly when you'll sell something, but I would guess that we're probably within 5 or 6% of a point at which we would sell Sigma, and that's a reasonably significant portion of our assets that's showing a reasonably significant capital gain. We won't probably incur or obtain too much option premium income when markets are high. We tend to sell more options when markets are falling because we want to be buying more shares in those environments. Secondly, in those environments, volatility tends to increase. So at the moment, the dividends and interest look good going forward. Capital gains are going to be variable, but we have some that are probably close to being realized. Options premium, we won't make too much money going forward over the next 6 months on current expectations. But if the market fell, that could change pretty quickly. Just go on to the next one there, Chris. We've bought a little bit more of one stock. Markets are setting records, particularly in the States, but in Australia as well. So it's not generally the best time to be buying lots and lots of things. But as is always the case, even when markets are high, there's always something that's reasonable value, or generally there's something that's reasonable value. So we've been buying more Woodside. It's a globally significant company. It's in the top 15 of producers of LNG. It pioneered the industry in Australia with the Northwest Shelf off WA. That particular project, for instance, has reserves and, importantly, environmental approvals to operate until 2070. I guess the reason it's attractive is the price is quite low. The price is probably low from our expectation or our inference, because people are concerned about the transition away from carbon. I think in any environment, the likelihood is LNG is going to be a transition fuel for that transition. So I think people are being unduly pessimistic on the prospects for Woodside, particularly if we're focusing just on the Western world, for want of a better word, perhaps that transitions off carbon fuels quicker. But the other countries out there, the Chinas, the Indias, are going to have a growing need for LNG. So we think it's pretty well placed long term. And as you can see from the far right bar there, it's selling at reasonably, or not reasonably, very cheap multiples. So low debt, very low PE, below 6 times, and then a very healthy dividend of above 11% per annum. So to us, it looks like a scenario where the market is looking as if everything's going to be bad going forward. And we're looking at it thinking it won't be anywhere near as bad as the market is expecting. And because of that, we're able to buy a very well-run company, a very great resource at a very low price. So that's one of the things that's popped up in the last half year that we're pretty happy to keep buying.
That's great, David. So just quickly reviewing some of the current metrics, the current net tangible assets are at 98.5 cents a share after the dividend. The current market capitalization of the company is 29.6 million, with the intention to soft close the fund at 100 million. David, would you add anything else?
No, I'm comfortable with that. We always want more shareholders. And Chris and I are more than happy to talk to anyone, anywhere, at any time. So give us a call. We're happy to run you through how we do things. We're open book. Ask any questions and they'll be answered.
Thanks, David. If you're not currently one of our shareholders, please pause the presentation and read the slide entitled Next Steps. Importantly, if you wish to find out more, please call or email. And as Ian mentioned at the outset, our shareholders are neither clients nor customers. They're partners and fellow investors, and we pride ourselves on our personal availability to them. If you'd like to talk to Chris and David, perhaps via Zoom, please contact us with some days and times that suit you. Thanks again, everyone, and we look forward to our next quarterly update.
Thank you.
Thanks.